In a CNBC exclusive interview, San Francisco Fed President Mary Daly, also our own Steve Leisman, is joining us. Good morning to both of you. President Daly, you said at the beginning of the week that you thought a couple more interest rate hikes were necessary this year. That was before we got the CPI report and the PPI report, and CPI was a lot softer than expected, now only 3% on the headline. Do you still think we need a few rate hikes this year?
So what I said is that that's a reasonable projection, and I think the most important thing about a reasonable projection is it preserves optionality. Now, there is no doubt that the good news on inflation is good news indeed, mostly for American consumers who are going to have some relief in their pocketbooks for high inflation. But I think it's too early to judge, and Steve has heard me say this more than once, it's really too early to say that we've declare victory on inflation. This month of data is very positive. I hope it's part of a downward trend in inflation, but I am in a wait and see mode on that because I remain resolute to bring inflation down to 2%.
President Daly, could you talk about the sorts of things that some folks thought might alleviate the need for you to hike more? Things like bank credit tightening and also the lagged effects of monetary policy. One of your colleagues thinks that we've seen the effects we're going to see. Do you still see more to come from the 500 basis points that you've raised?
So the way I think about it is, and I start with the research evidence that comes out of the economics profession, and what we find again and again is that the lags in monetary policy, there is no real consensus, but there's a rough estimate. They're between 12 and 24 months, and that's a lot of time difference, but still 12 to 24 months. If you think about when policy first became restrictive, it was last year, middle of last year to September of last year. So that means there's still, in my judgment, cumulative effects of monetary policy to work their way through the system. And I think that's part of the slowing we're seeing right now in the labor market, in inflation, in consumer spending. These things are all consistent with the lag still working their way through. But I also recognize that we can't just, hold out hope that lags are going to solve all our problems, which is why we have to remain resolute to do enough, bring the rate up to a sufficiently restrictive place, and then hold that rate for the time it takes to bring inflation clearly back down to 2%.
How about bank credit tightening? Is that something you still see is going to slow the economy?
It's a great question. And right after the initial banking stresses, my own estimate was that could be being important, worth about 1 or 2 rate hikes. And at this point, when I talk to banks throughout my 12th district and look at the aggregate banking numbers throughout the United States, you really don't see that kind of credit tightening. You don't see right now credit tightening that's far in excess or even in excess of what you would expect given a slower projection for the economy and economic growth. So I take that as there isn't as much credit tightening as I thought, but I do think that from the research literature that this takes a while to show itself. And so I think we're still looking into the fall before we would have a declarative statement to make about the extent of credit tightening and the effect on the economy.
Yeah, so far so good, as you say, on that front, President Daly. So if you look at that and you look at some of the recent data, the fact that housing looks to be picking back up again, that the growth figures are pretty much intact, the consumer's not falling apart, the unemployment situation is not really a problem. It's still a tight labor market. Does it make you worry that inflation could bubble back up here and that you might need to go even farther to protect that scenario from happening?
Well, I'm certainly mindful of the fact that while we've put over 500 basis points or about 500 basis points of tightening in the system over a rapid period of time, we still have an economy that has a lot of momentum. And this is why we continue to say, well, we are going to keep working on rate hikes until we are sure that inflation is on a path to come down to 2%. It's one of the reasons, as you mentioned earlier in the program, that, I said 2 rate hikes this year is still a reasonable projection. It's for that very reason you said. It is a risk that we under-tighten. It's a risk that we over-tighten. And that's why data dependence, meeting by meeting decisions is so important right now.
And I would imagine wage growth in particular. How much do you weigh that as a factor, and what do you see happening there?
So one of the things that I think is an underknown fact is that wage growth often follows inflation. And so it's really hard to say that wage growth is going to lead inflation down. But we do know firms are paying a lot more to compensate their employees. And yet at the same time, and this is the irony of this particular expansion, is that firms tell us that they're paying more to get workers, and workers are telling us their wages can't keep up with inflation. So it is ultimately the job of the Fed to bring inflation down so that we have a normally functioning economy where workers get paid, firms feel like they can still make a profit, and workers don't feel like they're falling behind on a treadmill each day because inflation chews away their wage earnings. That's what we're trying to do.
President Daly, I want to shift gears a little bit and talk about the demise of Silicon Valley Bank, which was in your district. Viewers know it was in the San Francisco district. And we've reported here on CNBC that bank presidents are not in charge of the supervision of banks that size. But I do have a couple questions from the reporting that I've done. Were you aware of the interest rate, of the flaws in the interest rate model at Silicon Valley Bank, even though you did not have direct supervision over the bank?
So the way supervision works, and it's a really good opportunity to help your viewers understand how Fed supervision works. It is directed by the Board of Governors. The supervisory framework is in the board at the Board of Governors, and then the reserve banks. I have teams here in San Francisco, supervision teams, and they report to the Board of Governors. And this keeps me ring-fenced, rightly so, from the day-to-day operations of supervision, so that we can have Greg Becker, for instance, sit on our board and not be concerned that there's crossover. So one of the things that the viewers, I think, need to know is that bank presidents don't have a direct role to play in supervision. And in fact, that's a feature of the system that prevents conflict of interest and also allows continuity. If you're a bank in North Dakota, you're treated the same way as a bank in California. So that's the answer to the question. I'm not regularly aware of these things.